So today I want to call attention to the impact of the regulations on the financial services sector, in particular the impact on our community banks. I might add, in discussing this before on agriculture, energy, and health care, we talked to the stakeholders involved in Kansas, the people who are actually involved. It is their suggestions that I am repeating and that I have tried to encompass in my legislation. The financial services sector of our economy is already the focus of substantial regulation. I think everybody understands that. We all support common sense financial regulations. However, it is important that financial regulations do not become undue burdens, especially on our banks that are the backbone of Main Street and finance the economic growth in our communities. Now, while I appreciate that many of the agencies with responsibility for regulating the industry are independent of the executive branch, I am hopeful that these agencies are receptive to the President's effort. While the economic crisis focused attention on the financial services industry, leading to the passage of the Dodd-Frank bill, our nation's community banks, who were already shouldering an undue regulatory burden, will now bear a greater burden when the hundreds of regulations from this law are implemented. I should probably say thousands. Our nation's community banks are small businesses. On average, a community bank has 37 employees and approximately $154 million in loans and other assets. The majority of banks in Kansas have an average of less than 14 employees. However, they currently comply with 1,700 pages of consumer regulations alone. That's incredible. They must also comply with hundreds of additional pages of regulations regarding lending practices and other banking operations. Now, according to a summary of the Dodd-Frank Act, this legislation mandates that 11 different agencies now create at least 243 more regulations, issue 67 one-time reports or studies, and 22 new periodic reports. Many of these new rules are required to be issued in the next year or two, and financial regulatory agencies have the discretion to issue additional rules on top of those, and those required under Dodd-Frank. This is incredible, if not unbelievable. Regulators have already issued more than 1,400 pages of regulatory proposals. Up to 5,000 pages of regulations are expected. Many will be proposed by a new bureaucracy that is created in the Dodd-Frank Act, the Bureau of Consumer Financial Protection. Remember that name. The acronym is CFPB. SUFPUB, I guess, is the name that you would call it. And SUFPUB will doubtlessly suffocate a lot of businesses. It will have broad authority to monitor, regulate, and direct the activity of banks. These actions will create additional and significant compliance costs that will impact the ability of every bank to serve its community. These actions have real costs to banks. According to recent testimony before the House Oversight and Investigation Subcommittee, the CBO Director, the Congressional Budget Office Director, Douglas Elmendorf, said the Dodd-Frank Act is expected to impose nearly $27 billion in new private sector fees, assessments, and premiums. This amount includes more than $14 billion in new fees on banks. And guess where that money is going to end up in regards to consumer costs? Now, our community bankers and their customers are worried about the impact of these new requirements. That's got to be the understatement of my remarks. They are frustrated, they are angry, they are upset. Now, not every regulation will apply to the community banks. They tell me the rapid pace and volume of new regulations being put forth are placing a strain on any bank's compliance capabilities and are adding significantly to their operating costs. Many banks tell me they are reevaluating whether they can afford to offer some products and services such as mortgage lending. Yep, you got that right. If you live in a small community and you go to your local bank and you'd like to get a loan in regards to finance and mortgaging, sorry, they're out of the business. It is important to understand that banks do not oppose common sense regulations. That's not what I'm saying. They are necessary to ensure that banks are doing their jobs and that consumers receive the proper information and disclosures that are beneficial to them. The problem is that unlike bigger financial institutions, our community banks do not have a large staff of attorneys or compliance officers to help them navigate wave after wave of these new regulations. By one estimate, for the typical small bank, more than 1 out of every $4, 1 out of 4 of operating expenses is used to pay for the cost of complying with government regulation. And with Dodd-Frank, we can only expect that cost to go higher. One community banker tells me that they have 5 compliance officers out of a staff of less than 100 employees. In speaking with compliance officers, they tell me that regulations that are being put forth to implement a range of new requirements are being written too quickly without specifics and guidance for banks to implement as intended. They point to regulations that are duplicative or contradictory, but which they must comply with, even if the banker or the consumer does not view the regulation as having any value or benefit to the consumer. I might add, even if they can understand it. Such compliance efforts cost time and money, and it is vital that federal regulators consider the total impact of all regulations, not merely each regulation in each isolation, and work to reduce unnecessary regulatory burdens on an already heavy regulated industry. Now, with these concerns in mind, I would like to call attention to several regulations that highlight the impact of an overly burdensome regulatory environment. I encourage regulators to join the President's effort to pursue solutions to regulations that make it difficult for our community banks to serve their customers, support businesses in their communities, and help grow our economy. The Dodd-Frank Act requires the Federal Reserve to issue a rule for debit interchange fees. Basically, interchange fees or swipe fees are fees that a merchant bank pays to a customer's bank when the customer uses their debit card. In December, I joined a bipartisan group of senators in writing to Federal Reserve Board Chairman Ben Bernanke, expressing our concerns with the interchange provision and to encourage the Federal Reserve to ensure that our consumer interests are protected in rate standards that are set. Our letter outlines, quote, concerns with the consequences of replacing a market-based system for debit card acceptance with a government-controlled system, as well as concerns that the provision will make small bank and credit union debit cards more expensive for merchants to accept than those cards issued by larger banks, and would likely put them at a disadvantage compared to the large banks that issue those other cards. In addition, the rule does not consider all of the costs incurred by a bank in actually providing the service, such as all the costs for fraud control, prevention, network processing fees, card production and issuance costs, fixed costs including capital investments. These are all significant costs for many banks and will be one of the factors they will have to look at when considering whether they even continue to offer any debit card service. Now, during debate on the debit interchange amendment, supporters presented it as a pro-consumer provision, maintaining that the reduction in interchange fees would be passed on to the consumer. Yet there's nothing Nothing in the Dodd-Frank Act that requires retailers to pass on any savings from debit interchange fees to their customers. On the contrary, the debit interchange rule will likely result in higher bank fees, a loss of reward programs, or banks may ultimately, as I have said, decide not to offer debit cards to their customers. Some are already doing that. Some steps are already being considered. Higher fees or limited choices as a result of such government price controls does not benefit any consumer. That's why legislation I am supporting calls for the Federal Reserve and other federal financial regulators, slow down, fully study this issue, carefully evaluate the 11,000 comments that were received on this proposed rule. I am particularly concerned about the estimated cost of the debit interchange rule for our community banks, which is not insignificant. Now, supporters of the interchange rule say that our community banks will not be impacted. Well, I beg to differ. Now, consider what I'm hearing from the community banks in my state of Kansas. One community banker in a town of just 1,000, whose bank began offering debit cards a few years ago, tells me the cost of the interchange proposal will cost his bank $19,000 a year. Two other banks that serve multiple rural communities will see increased costs per year of more than $46,000 and $100,000, respectively. Other banks, including banks in my state, estimate the cost to be in the millions. Ultimately, loss of income for banks will mean less capital available to lend to borrowers. Now, I also want to mention the concerns I'm hearing about the patchwork of mortgage disclosure requirements. Taken together, existing regulations and anticipated regulations as a result of Dodd-Frank may well have the effect of making it more difficult and costly to provide mortgage loans to qualified borrowers, reduce lending capacity, and may push, already pushing, some lenders to simply stop offering mortgages. One example is the SAFE Act. It creates a nationwide mortgaging licensing system and registry, for mortgage loan originators. Now, this registry is intended for use by regulators to identify mortgage brokers or lenders who seek to work in a state after being banned from working in a different state. That sounds all right. However, each mortgage loan originator will be required, banned or not, will be required to register with the National Registry, obtain a unique identification number, and submit fingerprints for the FBI to conduct a criminal background check. So if you're in the business of trying to be a mortgage loan originator, you're going to get fingerprinted. You're going to be on file with the FBI. Our community bankers tell me their cost to meet the new requirements, if anybody would ever want to step up to this, is roughly $1,000 to $2,000 per loan officer. I know that might not seem like a lot of money to Washington regulators, but it is a tidy sum in rural America. The cost of compliance will take time and money away from the business of lending and may ultimately be passed on to the consumer in the form of higher prices for a mortgage loan. That's what will happen. Finally, I want to mention the recent guidance on the overdraft payment programs put forth by the FDIC. Now, at some point, most of us have had experience with overdraft programs, perhaps when we forgot to balance our checkbook. In the guidance, the FDIC stated, quote, "The guidance focuses on automated overdraft programs and encourages banks to offer less costly alternatives. If, for example, a borrower overdraws his or her account on more than 6 occasions where a fee is charged in a rolling 12-month period. Additionally, to avoid reputational and other risks, the FDIC expects institutions to institute appropriate daily limits on customer costs and ensure that transactions are not processed in a manner designed to maximize the cost to consumers." So while banks offer overdraft protection programs now and take other steps to aid customers in avoiding overdrafts, many are concerned that this guidance put forth by the FDIC is overly prescriptive, nice word for it, imposes new regulations, and goes farther than amendments on overdraft put forth by the Federal Reserve. Further, banks note that the guidance seems to contradict the intent of the President's executive order that requires agencies to propose or adopt regulations only upon a reasoned determination that its benefits justify its cost, recognizing that some benefits and costs are difficult to quantify. Banks are concerned that the FDIC guidance is based on outdated information and that the impact of the Federal Reserve's rules on overdraft programs should be reviewed before moving forward with additional guidance in this area. So while the FDIC is not subject to the executive order, I certainly hope that they would adopt the spirit of the order. In addition, when a customer has a pattern of excessive use of automated overdraft programs, the FDIC states that banks should contact their customers about a more appropriate and lower-cost alternative that better suits their needs. You know, I can remember a bank scandal back in the House of Representatives. If only that bank would have had this protection from FDIC, none of that scandal would have ever happened. This is ridiculous. The FDIC recently provided additional clarification on this guidance that provides some flexibility about how banks reach out to customers and permits them to contact customers by mail as well as in person and by telephone. However, the requirement that banks contact customers who incur 6 overdrafts in a rolling 12-month period remains a broad overreach of the FDIC's authority, putting the burden on banks rather than the customer, who ultimately bears the responsibility for ensuring that they have sufficient funds in their account to cover their transactions. In fact, one study shows that 77% of customers paid no overdraft fees in the previous 12 months. That same study also showed that for those 21% of customers who paid an overdraft fee, 69% say they were glad that the payment was covered. Another survey found that 94% of those surveys said they would want a transaction to be covered by their bank, even if it resulted in an overdraft fee. This guidance seems to be a clear example of where an agency is overreaching, with little evidence of the need for or effectiveness of such additional guidance. Mr. President, in closing, I thank again the President, I'm talking about President Obama, for taking a step in the right direction to review federal regulations that place undue burdens on our nation's economic growth and recovery. I hope that financial regulators will join in this effort to examine rules and regulations that pose significant barriers to our small community banks and their ability to serve their customers and contribute to the growth of their communities. Thank you, Mr. President. I yield the floor and note the absence of a quorum.
The clerk will call the roll.
Mr. Kaka.